Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take us off course, and I help to make it actionable, understandable, and clear. What a week. What a show. We are going to be camping out more than we ever have on a single article because of the sheer volume of information in it. We're going to be looking at Business Insider. Bethany McLean wrote about Blackstone's big gamble. This is related to their private REIT, BREIT. And there is just a torrent of lessons and learnings to be had in Miss McLean's article. By way of introduction, Bethany McLean, I believe, co-authored The Smartest Guys in the Room about the Enron scandal, but also helped blow open the Enron scandal. So when she writes, the world is listening. And yes, the market update includes the world in this instance. We're also going to just spend some time in Robert's Corner. We've heard you. We're listening. We are going to talk about money market funds. So this week I had just some excellent conversations with folks regarding what additional risk am I taking to get the extra yield on, for example, the Vanguard Money Market Fund at 5.26% as of today versus online bank ABC that's offering me 4.35 or something like that. What am I missing? You always tell us not to chase yield, Robert. What am I doing? And then if you didn't think we're going to have too much fun in this episode, we're going to have so much fun. We're actually going so far deep into Robert's Corner, we're going to get into the particularities of paying medical bills in the hard scrabble Wild West world that is. Many of you probably have extensive experience with this. I give you a little lesson from my own experience this week in the corner. That's why everybody wants to go into the corner. It's always a wonderful day in the neighborhood. But let's start. Business Insider, Miss Bethany McLean. Headline, Blackstone's big gamble. Has the world's largest private equity firm built a $114 billion house of cards? Question mark. Woo. Now that is a way to get some clicks. In 2017, Blackstone, this is kind of the background here, decided, you know what? And now Blackstone is a private equity firm, one of the largest, most renowned, revered in the world. It is a publicly traded company led by a gentleman named Steven Schwartzman, whose net worth approaches $40 billion. These are the big guys, okay? So the reason why this article is garnering so much attention this week is because Miss McLean is taking a shot at one of the largest private equity houses in the world. Now, so they decided, you know what, we've always been catering to these institutional investors, these endowments, these pension funds. What if we went after some individual investors and were able to have a vehicle that others could participate in? So they did. BREIT became a giant quick. At the peak in 2021, the article explains the fund was attracting, check this out, $3 billion a month in new investments. Let me say that again. This private REIT was attracting $3 billion a month. Private REIT being compared with a public REIT. So a public REIT would be something like Simon Property Group or Public Storage or American Tower. These are REITs that trade all throughout the day like a stock, like Berkshire Hathaway or McDonald's. Whereas private REITs, you actually rely on the REIT, the company, to tell you your net asset value. They actually give you your documents, and not so different from the way private equity would work, and say, hey, all right, Mr. Smith, you own this many shares. We value these shares at X. This is what they're worth. In a public setting, and the market tells you what it's worth, and your liquidity is instant. You click a button, you can sell your public storage shares. You can sell shares of any sort of public REIT whenever you want during the trading day. So hold on to that thought, because that's where it's going to get interesting. So Ms. McLean explains, over the past 2 years, some investors have begun growing suspicious that BREIT isn't the rock-solid investment Blackstone claims it is. Since its inception, the fund says it's delivered an annualized net return of 10.5%. That is double what the index of the publicly traded REITs did. Okay, so here we go. That's not impossible, but there's some divergence there. You'd think, wow, but it's such a big fund, BREIT is. It would seem difficult to outperform by that much. You might expect that in a smaller, more niche fund that had a particular real estate focus, like data centers, where you say, oh yeah, if you're an exclusive data center fund, sure, that could happen. But BREIT, the article explains, managed to defy gravity. So as interest rates are going up in the fall of 2022, a lot of folks said, I'll take my money back. So the way it works in these private REITs, differing from the public REIT, we just click a button, sell our shares, and we're all done. The private REIT, you have to go and say, hi, I'm John Smith. I'm an investor. I'd like to withdraw my money. And based at the net asset value that you, Blackstone, have determined my portion of the fund is worth, please send it to me. So that created some trouble back then. Okay. So Blackstone then started gating money, meaning we're not going to just pay you immediately. We're actually going to gate you, meaning we're going to slow your roll and all of your investing peers' roles, where we're only going to provide liquidity to those on a first-come, first-served basis, so that no more than, say, 2% of the net asset value, the assets of the firm, can be taken out. Okay. Wouldn't you know it, the BREIT, this private REIT, did it. They were able to fulfill 100% of the repurchase agreements request, and it slowed the run on the bank, so to speak. All these people who wanted their money, they actually got it. So the thought was, hey, maybe they're out of the woods. Well, maybe not. So as you know, interest rates have stayed high. There was always this consensus that, oh, no, interest rates will go back. But this article quotes folks, a Nate Kopikar, who runs a hedge fund called Orso Partners. He says this. He says, it is the absolute definition of a Ponzi scheme. Those are fighting words now. Because why is he saying that? He's saying when this BREIT faced a flood of redemption requests, these investors that wanted their money, it only fulfilled those requests after it raised cash from new investors. And it did. What the folks at Blackstone did is, okay, we need this cash. We don't want to sell these assets right now. What we'll do is get new money. Okay, so if you know the way Ponzi schemes work, again, I'm not saying this is one, but you pay your existing investors with new investors' money, and it gives the illusion that it's actually the assets that are doing the work, not the new money. So this gentleman, I believe, is shorting the stock, so let's keep that in mind. We'll be as balanced and fair as we can. What is being said now by many is that Blackstone, they misled investors over the past 5 months, and that this was created for the benefit of Blackstone. This is a Craig McCann, a financial analyst who served as an economist at the SEC. He said investors should not accept anything Blackstone and BREIT state as truthful. That's the BREIT. Yowzas. Again, this is a huge deal because Blackstone is not some run-of-the-mill kind of private investment house that started 2 days ago. This is a huge company that's well respected, but it's the structure that's the issue. So you guys remember the old adage: keep your costs low, keep your investing simple, keep your time horizon long. Clap, clap. Does BREIT satisfy that standard? Keep your costs low? Not even close. This article explains that part of the reason why there is such an incentive for Blackstone to keep the marks, meaning the communication they're showing their investors is their assets are not going down, they're going up, is because they earn fee income based on the value of the assets. And lots of it. Lots and lots and lots of it. So it's a conflict of interest, but keep your costs low? No, they did not keep their costs low. Investing simple? It's not that bad, but it's pretty bad. It's kind of black boxy in that you're not really sure how the assets are coming together to meet the net asset value figures that you're being given. It's so much money that's tough to make sense of. I bet if I interviewed 50 BREIT investors, whether institutional or individual, and asked them to try to ascertain as to how they come up with the share price they have, I don't think I'd get one to be able to do it. And that's a problem when Blackstone's the one giving you the value. That's a problem. So cost low, investing simple, time horizon long. This is where they get in even more trouble. because the time horizon can be long in a public REIT. The price goes up, the price goes down. You don't have to sell. In this instance, the structure, and we'll see. I mean, maybe this works out. I actually hope it does. I think this would be very bad if something like this were to really blow up for a lot of people involved. So my hope is that it does not. But time horizon long, it's this gating thing where you can have a run on the bank, where the vehicle in a traditional public REIT, like public storage, that you've probably seen public storage, where you can put your junk in these little locker bins and whatever. There's no run on the bank. If a bunch of people sell their shares of stock, the share price would probably just go down, or not. I mean, the share price could stay the same. We don't know, but it doesn't affect the fund's net asset value. Here, it does. They have to pay out to people. The time horizon long, it doesn't fit. So what'd they do? What's BREIT doing? So in January of 2023, BREIT announced that the University of California invested $4 billion in the fund. Aha! But it wasn't straight up investment. They gave it some sweetheart deal to give them liquidity, an additional $1 billion in stock if the fund's rate of return fell below a certain mark. I mean, it was just very, very friendly to the new investor, maybe not so much to the existing investors. So Blackstone says, no surprise, all is well. We have great assets, no problem. Nothing to see here. Nothing to see here. But regardless of how this turns out, if I were an investor in BREIT, I of course would want my money back today, because what's happening? BREIT's saying our assets are doing great. All the publicly traded guys are going down. That just doesn't smell right. How could that be? And then here we go. Here's what's really insidious. The way BREIT is structured. So if you're listening and you own BREIT, I can bet there's a reason why you own BREIT. Blackstone paid Wall Street banks and brokers more than $700 million in brokerage fees. For brokers who put their clients in BREIT early on, those commissions could soon hit a mandated cap of 8.75%. What? A mandated cap? You're telling me they could have higher commissions? So this thing was sold on commission. Oh dear. That so much for our costs being low. So what this article is saying is, look, if it is the case that these brokers are no longer able to sell BREIT on commission, that could dry up new money going in, which would really put pressure on BREIT. So we could go into. You guys have been great listeners so far. This has been a more academic article than ones I've done in the past. I think it's important, though, that an article like this, we actually camp on a little bit and say, wow, you don't have to do stuff like this, investor. In fact, when something like this is pushed with commission structure and brokers behind it, you kind of figure, okay, this is why bad stuff happens. What's the worst case scenario? Worst case scenario is there's a run on the bank. Everyone wants their money out. Blackstone realizes, they have a ton of debt on all these buildings. There could be a fire sale, and you could be left picking up the pieces, meaning not getting anywhere close to what Blackstone says your net asset value is today. Because it would be bad for Blackstone to have everyone want to sell. Then they are having to sell all their choice assets in a higher interest rate environment when, guess what, real estate values are lower. So keep it simple. You don't have to do this stuff, this BREIT or anything else. It's all that glitters is not gold. And step on into the corner. Tell the children to gather close. We're talking money market funds. So it is almost always the case that every week I'm kind of pushing a client to put their money in money market funds rather than sticking them in their brick and mortar bank. Unless, of course, the brick and mortar bank is some great online bank that offers great rates. But even then, I'll still at least cast the vision for, you're probably going to get a higher yield today. It's not always the case, but today in a money market fund, 5.26%. And I was asked an excellent question this week. Well, okay, there's a delta there. There's a difference between the 4.5% that an online bank gives me and the 5.26% that Vanguard's offering me. The market somehow is offering higher interest. Why is that? What risk am I taking? What risk am I being exposed to in a money market fund? Well, my simple answer is not a ton. I mean, if you go with Vanguard's money market fund, it's run very conservatively. I don't worry a minute about it. But go worst case for me. Okay, I'll go worst case. Something called breaking the buck did occur did occur, '08. There was the Reserve, which is a New York-based fund manager that specialized in money market funds. They had about $65 billion in their reserve primary fund. And that fund had a $785 million allocation to short-term loans issued by Lehman Brothers. This was commercial paper, and it became worthless when Lehman filed for bankruptcy, and it caused the NAV, the asset value of the reserve fund, to fall below $1. So this is like cataclysmic worst case. What do you think the worst case scenario was for this fund? This is the fund that was exposed to this stuff. 97 cents on the dollar. It got that low. Now, that's not great because you never want to break the buck. That's a huge deal. We're breaking the buck. That's how bad it got. Not to say it can't get worse. Of course it can, but that was one instance in one time, and it took a whole lot. And what'd you lose? Just about nothing. Oh, by the way, during that time, if you were at a bank, you were probably scared to death because you didn't know if a bank would fail, whether you had adequate FDIC insurance. So the money market fund at Vanguard and Fidelity and Schwab, you should have a lot of confidence in as an investor and not worry about it. It holds a whole host of short-term, high-credit instruments that are designed to be low risk, high credit quality. And if you lose a ton of money on your money market fund, your problem is that not that you lost money in the money market fund, so there are no groceries on the store shelves because it would be that cataclysmic. It would be an entire meltdown of the financial system, which can happen, but I wouldn't plan on it. And then on closing here, Robert's Corner, medical. I was told, Mr. Hunt, you owe $2,875.93 for some medical procedure that we ran through your insurance. I said, oh, how interesting. Thank you for that information. What would it cost if I paid with cash or credit card? Oh, credit card? Yeah, that's $550. And it just shocked me. So let this be a lesson to us all that some systems are more broken than others. The medical billing system is one of the most broken systems. And it is in your best interest to always at least ask, yeah, great, thanks for running it through my so-called pre-negotiated insurance rate. What if I just pay the credit card? And that rate may drop precipitously. So in that spirit of keeping the cost low, always be willing to ask, hey, what's the cash price? Because I'd never seen it drop this fast by a factor of 5 with a one question. So as always, keep those costs low, keep that investing simple, and keep that time horizon long because that's what's going to give you the best shot on your investing journey. Until next week.